we're going to have an inflation rate that is probably in the vicinity of 5%-ish. But it's a very uncertain inflation rate because of all the shocks that we have around it. But let's say 4.5%, 5% is probably what it settles down at after this tightening. The real rate, in other words, the rate above inflation that the interest rate is now at, is in the vicinity of 1.5%, a little bit higher than that. So that would mean that there would be probably approaching a 6% risk-free rate, and the Federal Reserve will put the short-term rate up toward that level. That level of interest rate is very harmful, very damaging to the economy, but what the Federal Reserve is trying to do is balance those, having an interest rate that's high enough for the creditor, but not so high for the debtor. And so I think what you're going to see is a slowing of the pace of the rise, but an approaching, let's say, over 5%, probably in the vicinity of 5.5%. And that'll have an effect on all markets. It'll have a negative effect on stocks, right, because it has, of course, as interest rates go up, they compete, and then there are the challenges. And of course, that interest rate is the government rate. If you have low-grade credit, you can add 5 percentage points to that. So you're talking about a 10, 11%, which will have a very severe negative effect, particularly on companies that have relied on receiving funding on an ongoing basis. In other words, they don't have enough profits to carry themselves. What's priced in the markets is that there will be a sharp fall in inflation rates. We do know that there will be a fall in inflation rates as some of the exogenous factors like the oil price won't stay up at where it is, and such things, some commodity prices. We're seeing that already. We're seeing that in housing prices and so on. So that'll bring it down some, but that brings it down from numbers that are in the vicinity of 8% to something that's lower than that and not sustaining. The wage sector, the employment sector, is going along relatively well, because unemployment rate is low, so there's still demand, and the inflation that we're seeing is also coming from compensation inflation. So we're going to see those rates have to rise. So you see that built into the curve is a fall off in rates and a fall off of inflation. And I believe that you'll see it staying higher than those levels that are built into the rate. There's so many demands on money. We need money for poverty alleviation, building infrastructure, repairing the Ukraine, spending money for climate change. No longer do we have a mentality like an individual might have. They might say, how much money do we have and what should we spend it on? The big difference between individuals and governments is the governments don't have that constraint because they can print money. So I think we have this trade-off. Whenever in history you have a lot of debt and a lot of financial assets, it becomes very, very difficult for those to be balanced. And we're now in a shift. The prior decade, we had falling interest rates, which were goods for holders of bonds. Cash was very cheap, free almost. And so the whole investment landscape was very much built around that. Now we're having this adjustment away from that. So central banks try to balance growth and inflation. And so it will be a difficult balance, which creates an environment of stagflation, I'm afraid. Over the long run, look at your returns relative to inflation, whichever country you're in, whichever currency you're denominated in. Look at the returns relative to inflation. too many people look at just the level of returns and they don't pay enough attention to inflation. Generally stay away from debt assets, debt denominated assets. Third, have a well-diversified portfolio. Diversification reduces risk without reducing expected returns if you do it well. Also, don't be too tactical. I think you have to realize that the markets are a zero-sum game. And to compete in the markets is more difficult than competing in the Olympics because there are more people trying to do it and taking money away from others. So have a strategy which is over a long period of time, to save money in a diversified portfolio of assets. So those would be the most important things, I think. I needed to go back in history and examine what happened when conditions were similar to today. You'll see in that measures that go back 500 years and you will see cycles. Cycles are just, it's nothing predestined by a cycle other than their mechanical cause-effect linkages. And so if we look at the financial issues we just talked about, size of the wealth gap, printing of money and all. If you look at the internal conflicts and use measures, size of the wealth gap, size of political gaps, amount of populism and the like. And if you look at the external factors, the conflicts between countries, the military buildup and such, they are all, each one of those, the highest levels since the 1930 to 45 period, and you go back over periods of time, and they all interrelate to make less peaceful periods of greater conflict. And that's a period that we're in. And so when we look at that, you can see the geopolitical. In India, it's all big countries and many little countries are in the middle of that. So what we're seeing is no longer the minor country confrontations, something like the United States and Afghanistan or Iraq. It is now Russia and China. And there are 5 kinds of wars. There is a trade war, a technology war, a geopolitical influence war, a capital and economic war, and a military war, 5 of those. We are in the first 4 of those. If we never go to a military war, we are still having damage happening because we are still in an environment where globalization as we know it is declining. Because right now, in fears of those wars, there is the desire for self-sufficiency. It used to be that the world would come close to producing items and trading items wherever it was most efficient. That is now changing. Now it's wherever it's most secure. So you're seeing that change in global economics happen in an important way, resulting from these geopolitical changes. And we could find ourselves in a military war. I'm not saying that that's inevitable. I'm saying, though, that right now, there is not a United Nations or world court that resolves disputes. They're resolved in terms of these types of fighting. So, yes, it's very much an influence. And those influences then affect countries differently. Those that are in wars of those types have more problems than those that are out. Neutrality is important. The 3 things that I look at when I'm looking at countries is first, the financial. Do they earn more than they are spending financially? Do they have a good income statement and good balance sheet? Second, do people within the country operate in a harmonious, effective way, healthy competition, but not destructive political dysfunctional behavior? And number 3, Are they at risk of an international war, or are they more neutral and staying out of the international war? If they are those three, financially sound, operating well with each other, and operating in a way where there's minimal risk of being directly involved and they're more neutral, I favor those countries.